Okay, and this is the fair value through net income. Actually, for the fair value, we have fair value through the net income and fair value through the other comprehensive income. So this is the first one for the measurements from the fair value. So the fair value through net income referred to as fair value through profit or loss at acquisition, investment recorded at fair value. Okay, it's clear. And then transaction costs are expensed at each reporting date. Fair value investment are adjusted to current fair value with net holding gains or losses recognized in net income. Okay, under IFRS, earned interest or dividend income and any holding gain or loss on the investment may be reported together as investment income. Okay, so where if you have if your investment are adjusted to the current fair value, so you will recognize holding gains or holding loss immediately. Okay, and this fair value through net income is usually used, is only being used for the investment in debt instruments, but for trading. Okay, let's see the example. Assume that a company purchases $100,000 10% 5-year bonds of Kraft Corporation on January 1, 2020 with interest payable on July 1st and January 1st. The bond sells for $108,111, resulting in a bond premium of $8,111 and an effective interest rate of 8%. Okay, so the market rate is 8%. This is 10% is the bond rate. Okay, the entry to record the purchase of the bond, just record the investment, increasing in investment at the fair value, investment on debit side and cash on credit side. Okay, and then you need to do the amortization schedule to record the interest and bond amortization. Okay, so on July 1st 20 you will record cash 5,000. Okay, but the interest income is only $4,324, and then you record in the credit side investment 676. Okay, and then the next 6 months you will record interest receivable 5,000. You don't get any cash at the end of December, you just only interest receivable. Okay, and then interest income 4,297 and investment 703. This number is the amortization of the bond. Okay, this is to determine the gain or loss on fair value adjustment. Okay, so to record the fair value adjustment, you will record investment income or loss on the in this case the carrying amount before fair value adjustments is 106,732, and then you update the fair value. The fair value at the end of this year is 105,000. Okay, so meaning that the fair value of the investment is decreased, right? This is the carrying amount, this is the fair value. Okay, so meaning you need to record this amount of investment on the credit side. You see here, investment on the credit side, and then investment income or loss on the debit side. Let's see another example. Assume that investor pays 19,231 on March 15 for a 20,000. This is for investment in treasury bill. for a $20,000 6-month treasury bill that matures on September 15. The investment purchased to yield an 8% is designated as an fair value net income investment. Okay, so journal entry on March 15 is when you buy this treasury bill. You will record investment on debit at the fair value and the cash on the credit. Okay, and then the next entry is on September 15, so you will record cash on debit, okay, 20,000, because you sell this bill back, or and then your investment decreased for 19,231,000, okay, coming from here. So you to remove this number, because we're gonna remove this, right, to remove this investment. So you record here, and then you have the gain on disposal of the investment 769. Okay, the gain on the disposal on the credit side. And this is the investment in securities. Okay, so for the fair value through net income, sometimes it also used in investment in securities, but the securities is for trading. Okay, so if you have investment in securities, so in this case your securities, you have the portfolio, and the number is the carrying amount is $314,450, and then you update the value so that the fair value is $318,200 at the end of the year. So meaning that there is an increasing value here, so you have to record the investment on debit side for this number. So investment on debit side and investment income or loss 3750. Okay, sale and purchase of securities. So we still use the same data. Now assume that Ganestar bonds are sold for 174,000 on February 4, and 1,000 shares of Next were acquired at their fair value of 49,990. The journal entry to record the sale. Okay, so cash 174,000. Okay, based on the face value of the bonds, and then you credit the investment based on the fair value. Okay, fair value at the sale date, and then you will record loss on disposal of investment. Okay, because you receive the cash lower than the fair value of the investment, so you will get loss. And then number 2, sale of 1,000 share. Sorry, this number 2 is 1,000 shares of Next were acquired at their fair value. Or for number 2, the company buy more shares of Next company. Okay, so the company just record investment on debit and cash on credit for 49,990. Okay, and the next one is the fair value through other comprehensive income. At acquisition, investment are recognized at fair value. Okay, still at fair value plus transaction costs if you have. And then at each reporting date, fair value OCI investment are adjusted to current fair value, and any holding gains or loss is recognized in other comprehensive income. Okay, any holding gains or loss is recognized in other comprehensive income of income tax. Okay, which when investment are disposed, previously unrealized holding gains or losses need to be transferred out of OCI or accumulated OCI. Let's see an example here. We have the portfolio of shares, okay, from various company, and then we have the fair value at acquisition here. On December 6, 2019, the company received a cash dividend of $4,200 on its investment in the common shares of Columbia. Okay, for fair value OCI, this one you implement this one if you have an investment, but the investment is holding until maturity, not for trading. Okay, so in this case, you for this example, you receive dividend. Okay, so you will record cash 4,200 and dividend revenue 4,200. Okay, now assume that the company sells all of its Nova Industries common shares on January 23rd, 2020, receiving proceeds of 287,220. Investment in Nova shares was adjusted to fair value of 275,000 on December 31st, 2019. Okay, so the company wants to sell Nova Industries shares. As you see here, the company has the investment in Nova Industries, and at this time the fair value is 259,700, but at the end of 2019 these numbers already updated to fair value. The fair value at the end of 2019 is 275,000. So on January 23rd, 2020, the company wants to sell these shares, and we receive 28,220. Okay, so meaning that the company first needs to adjust to fair value on date of the sale. Okay, so the company will record your company will record investment on debit side and unrealized gain or loss on the credit side. Okay, because this is the new fair value, right? You receive this much of money, and then to remove investment from the account, you will record cash on debit side. You receive this much of money, and investment on the credit side. Okay, and then next, income from fair value OCI investment for debt instruments. Let's see here. So in this case, you buy a investment in bonds, so you will record investment on debit side 108,111 and cash on the credit side 108,111. Okay, this one is the fair value at fair value. And then next, to record the interest on July, you will record cash 5,000 and the interest income 4,324, and then investment on the credit side for 676. This is for the amortization, and the amortization you will record as investment. Okay, and then next is to record interest receivable on December 31st. Record receivable 5,000. Okay, and then interest income and investment on the credit side. investment in portfolio of bonds. So let's see this example. You have the portfolio here investment of portfolio. Based on the amortized cost, your total portfolio value is 293,537, and then you update the fair value. You update the value, so the fair value is 284,000. So meaning that the fair value is smaller than the amortized cost, for $9,537. So the unrealized gain of the bonds is netted with the unrealized loss of the Anacom bonds. The unrealized loss that is reported is this one. Okay, the portfolio, the unrealized loss of the portfolio. Okay. Next, investment in debt instrument of other entities. Sale of bonds. Continuing the previous example, the Chan bonds are sold on July 1st of the following year for 90,000, amortized cost 94,214. Prepare the journal entries to record the sale. Okay. To record the sale, you will record unrealized gain or loss on debit side, and the investment on the credit side. You want to update the value, revalue the investment to fair value. Okay. And then next one is recognize the sale. You receive 90,000 of money, and the investment decrease for $90,000. The next one is reclassify accumulated OCI to net income. So loss on disposal of investment 4214, and unrealized gain or loss for 4214. Okay. This is just the summary of the three major models of accounting for investment. Okay, so that's all for this part.